For the quality assets, the valuations are through the roof as they've always been. So we haven't seen any dent in that.
Hello, and welcome to the one-to-one Global Online Precious Metals event. Today, I'm here with Kevin McElligott, Managing Director, Australia at Franco-Nevada, to talk a little bit about the gold market. So, Kevin, thanks for joining me today.
Thanks, Amy. Thanks for inviting.
And let's get right into it. So, with the U.S. Fed focused on fighting inflation, interest rates have consequently gone higher. What is the impact that you've seen on asset valuations so far?
I got to confess, I don't think we've seen much impact on valuations, mainly because most of the projects or most of the assets we look at are gold assets, which are meant to be, sort of inflation-free, risk-free sort of rate of return assets. So we don't change our discount rate that we use in valuation as interest rates go up and down, the same way, say, a real estate investor might do it. So, for quality gold projects, you might be using, say, a mid-single-digit rate of return interest rate for the valuation. So what does that mean? The other thing that's changed is what we might see going forward, although it hasn't happened yet, is you might see the consensus long-term gold prices showing an actual uptrend, which if you look at it, it's all very flat right now. But once, if people believe that inflation is going to persist and higher interest rates are going to persist, then that should factor into longer term gold price analyst consensus predictions, which should then flow through to our valuations. Because we generally use that as a guiding number on the gold price assumption, simply because if that's the analyst consensus, that's how our investors and shareholders are going to be looking at what we do. So that's our reference point.
Are there, I guess, impacts to the general economy that you've seen from kind of these, this focus on inflation in the U.S. That is trickling down?
Yeah, look, we've seen it. I don't know what you've seen or where you are or elsewhere, because if you look at the headline inflation number, it's not that scary. You're getting into, depending on which country you're in, aside from a few outliers, it looks like maybe it's 5%, maybe pushing up to 10% in a place like England or something. And okay, nobody likes that. We got to increase interest rates, cool things off and stuff. But when you look at individual prices, I don't know of any individual price that's changed in the 5 to 10% range. It's either staying flat or it's up 30%. It's all, and to me, and that's where I look at it. I say, it's not the same as inflation in the 70s or 80s, where it was just across the board everywhere, this gradual grind that we would have all experienced. Here, it just seems really spotty. It's still related to disruptions. There were a lot of supply and demand disruptions related to COVID. Now, a lot of supply and demand disruptions related to war in Ukraine and sanctions. The big scare is, if China gets involved and gets some sort of, what would you call it, sort of secondary sanctions or something against them, nobody wants that. I wouldn't expect anything like that to happen, but I still think we're going to see what I call patchy or chunky sort of inflation stuff. Where we're seeing it in WA is certainly in labor costs and the mine development costs across the board. They're 30% over the last couple of years of what people were actually budgeting for. So, and that's something, those adjustments are just coming through. We're getting a lot of, well, it's not bad news. It depends which side of the fence you're on that. Obviously, if you're working there, you like it. But if you're an operating company and you're getting shocked on how much your costs are going to be on a project that you're investing in for the long term, there's some bad news coming through for investors, and it's still trickling through one by one as these projects update their assumptions.
Okay, interesting. I'm wondering if we can get a little bit deeper into kind of these other macro factors that are, impacting the gold markets. Like you mentioned, the invasion into Ukraine, the sanctions related to that, China. How has that impacted the markets overall?
Well, there was, initially, so we have almost exactly 12 months now. So initially there was sort of the shock 12 months ago, and things froze temporarily as everybody tried to sit down and assess, how does this impact us? A good example, there's a project here in WA that went into administration called Wiluna Mining. It was in June or July last year. But they had just done an upgrade to their processing plant, and they were going to be shipping off gold concentrates to a smelter, and it turns out their smelter was in Russia, and they were shipped off their first concentrates in either like December or January or something like that, and then of course end of February there's the invasion. March, sanctions start to hit. Next thing you know, it's like, oh, what do we do with our concentrates? I think, like I said, they went into administration a few months later, and I think talking to the administrator the last couple of months, they had loads of concentrates that sat there for 6 months. I don't know where they ended up going. They've all been shipped now, I think. Mm-hmm. But and it was just all those little disruptions. So stuff, there's the big headline stuff about, is Russian banks going to be allowed to participate in SWIFT, sort of the clearing for international money transactions, but there's so many little knock-on effects and stuff that you're not even aware of about where products come from, where they go to. So I don't think when the sanctions were first introduced, people realized how much grain came out of Russia and Ukraine through the Black Sea, and the effect that's had. We don't depend on exports of grain here, and probably not in Canada or Western Europe. All that grain's going down into Africa, South America, and when those people experience 30% plus food price increases, that's enormous for individuals or families living there. So that's if we can improve on that, if there's a way we can implement sanctions in a way that doesn't hurt people in marginalized communities in other parts of the world. God bless them. Whoever comes up with that, they're doing a service for the entire world there. So it's it's nice to take the yachts away from the guys, and that gets the headlines. But it's no good when people in other parts of the world are spending 30% plus more on their food.
Absolutely. And so I guess, looking at your role with Franco-Nevada, what's your general sentiment for gold moving forward?
Yeah, it's funny. It depends on when you ask, like month to month. It really flip-flopped over the last few months. I found, obviously, like I said, 12 months ago, started the invasion, everything just froze temporarily. Then things took off again. Projects are still going ahead. And the market was still kind of bullish because gold price got up a bit, and then the sort of third quarter, or definitely the fourth quarter last year, lead up to the Christmas holidays, a lot of bad news started flowing in. Companies with cost overruns and whatnot, and these are companies that had just already raised capital or raised equity in the share market 3 months or 6 months earlier, when the gold price was up and things were a bit more bullish, and they were like, oh, we're in trouble, we can't. So we were at a point, especially just before the holidays, where we were just inundated with people wanting to talk to us about financing or refinancing on projects, to the point where we just had to actually do sort of a cull and say, look, we can't look at 40 things, we got to pick a few to run with here. And then in the last, certainly 4-6 weeks ago, it flopped again. It just did a 180-degree turnaround again. A few companies did go back to the market. They did share issues at steep discounts. We've seen, I saw one a couple of days ago that was like a 25% discount to the closing price the day before, but it was a quantum of money. It was about $80 million that I wouldn't have thought that they could raise that in the market, but clearly the appetite is there from equity investors in gold. It's just a question of the price. So again, like I said, we had 40 companies wanting to talk to us, middle end of December, but a lot of them, they were able to raise money in the equity markets anyway, so it wasn't as bad as they thought it was going to be. So
interesting. And I guess in terms of the investment focus for you and your team moving forward, what's your focus for the coming year?
Look, it's gold. It's always gold for us. Certainly but we do have other commodities in our portfolio because it's a big portfolio. So it's roughly 70% gold, precious metals, and approaching 30% other commodities. Our other focus is for the other commodities is really the energy transition, battery metals. So we're trying to find a good investments in that space. It's I'm not going to say it's a struggle. It's more of a challenge because especially with some of the commodities where the bullishness has taken off, valuations are through the roof, and it's hard to pick winners. A good example is lithium here in Australia. I'm not sure what you're seeing in other parts of the world, but it seems like every other company has a lithium project that they're now trying to advance. And there's plenty out there. I'm sure some of them are going to, but trying to predict right now, today, which of these 100 projects are actually going to move forward in a significant way if the market cools off. It's really hard to pick. So we'll see. The only difference for us is when we get outside of the gold space, what we look for is more advanced projects that are either in production or near production. So then it really becomes, it's more about buying steady cash flow. And so it's more just a case of settling on the valuation, which again, on the lithium example, the issue there is you compare the spot price today to the long-term consensus price, which is about 50% or more lower than the current spot price. So settling on a valuation that people are happy with really depends on how long you expect the current prices to sort of persist. With a sort of supply demand imbalance. There's such a supply demand imbalance in lithium. It's like you can be producing anything, sort of sub-spec concentrates. There's processing plants that are hungry for them, which is great. You can sell those now, but I don't know if you'll be able to sell them 12 months from now. So we'll see.
Yeah, absolutely. And so my last question is really relating to royalties and streaming, and I suppose trends that you're seeing on that within that kind of segment of the investment industry. So trends, where is momentum building?
Yeah, it's hard to pick. The one trend that seems to really be persisting in a good way, it's not necessarily deals being done, but certainly the deal flow and the transactions. We're reviewing lots of projects. We're being invited in to review and submit offers on many projects that are looking for project finance and for development. And it's becoming much more the norm to include royalties and streams as part of that process. I think we've shed the word alternative. That might be a bold thing to say, but we'll see. It's just become normal to include royalty and streaming companies in the data room and in the process for bidding and stuff. And certainly on the projects where we're trying to progress with in terms of in making an investment, we're also seeing it very competitive. Any of the ones we like, there's other royalty streaming companies that like them as well, and the bidding is ferocious, and you come up with eye-watering valuations. So certainly yeah, spinning back to one of the earlier questions, what's been the impact on valuations? For the quality assets, the valuations are through the roof as they've always been. So we haven't seen any dent in that.
Okay, perfect. Well, quite interesting, and yeah, certainly things to be kind of keeping an eye on this year. Kevin, those were all the questions that I had today. So thanks for joining us.
Oh, thank you very much.